Hey everybody, Kevin Schoon here from MyBottomDollar.com, a site dedicated to providing wealth building strategies as well as investment tips and entrepreneurship tips. If you like what you see in this video, please like or subscribe or comment below. I'm open to constructive criticism. I always like to know what people want to hear. If you got any questions, I'll be happy to answer. Today I got my son with me. His name is Kier. Kier, say hi.
Hi.
In my last video, I talked about the difference between investing and investments, and I listed 4 investments, but 2 of those I'm going to speak of, and those are stocks and bonds. Kier, tell them what a stock is.
A stock is a piece of company, and a bond is you give money to people.
That's correct. So let's start with a stock first. A stock, as my son said, is a piece of a company. Companies usually take a percentage of their company and issue it out to the public, also referred to as an initial public offering. Those offerings are then sold on the secondary market after going through the primary market, whereby public, such as me, you, or anybody else you may know, will buy them at a certain share price or the price of it. Whenever you own a stock, it's considered a share, and the person who has the stock is considered a shareholder. Oftentimes, you might see companies have shareholder meetings whereby they may let or inform those shareholders about the different directions the company is going, new products, and answering any questions regarding the financials that may be issued a couple months or weeks before the actual shareholding meeting. There are 2 different types of stock. It's preferred stock and common stock. Common stock is the one where you pretty much just own the share of the company and whatever happens, happens. Preferred stock comes with a little bit of a bonus, but comes with a little bit of incentive. But the problem is, let's say if the company was to go bankrupt, you wouldn't get paid. You probably lose out. You're kind of like last in line. That's pretty much what a stock is. A bond, as my son said, what's a bond?
You give money.
That's right. A bond is when you issue somebody money and they pay you back with interest. Now, bonds they have what they call treasury bonds, which are like small bonds that literally come from the U.S. Treasury. You have municipal bonds, which are bonds issued by the city. And then you have regular government bonds, which is like bonds issued by the government, right? So these bonds can be anywhere from 3 months to 6 months to a year, 3 years, all the way up to 30 years. And they can have interest rates from, however many percent. It's really based on the actual interest rate that's set by the Fed. Interest rates are down right now, so owning a bond is not too lucrative, but it's a nice safe bet against stocks because stocks are too volatile while bonds more or less have more security. People who usually invest in bonds are those that are like retirees or people that don't have a high risk tolerance when it comes to stock. So they kind of use those to help balance out the losses. Let's say if a stock goes down. Also, a stock, just much like a bond, both stocks and bonds have ways that they pay what they call dividends, right? For a stock, it's just called interest payments, but for bonds, it's called interest payments. For stocks, it's called dividends. Dividend stocks are usually stocks that are like blue chip companies. Those are companies that's probably been around for 20, 30 years and have solid financials, i.e. McDonald's, Xerox,
Don't say McDonald's.
Yeah, McDonald's, man. Don't you love McDonald's?
Oh, yeah.
McDonald's, Xerox, John Deere, companies that's been around forever that are probably not going anywhere in the next 10, 15, 20 years. So those are ideas of blue chip stocks, and they have like what we call dividends, which are quarterly payments. Sometimes they're semi-annual, sometimes they're just annual or even one-time payments, whereby a person take a percentage of the share price or the percentage of the earnings earned for that period, and they divvy it out amongst all the shareholders. So let's say, for example, Ford has a 15-cent stock, and they pay quarterly. So let's say you owned 100 shares of stock, you would get, that's $15, right? $15, but they pay it every 3 months, so you would get $45 because that's every month of that you've owned the stock. You usually have to own the dividend stock prior to a certain date, and if you don't, then you don't get the dividend for that quarter. So that's an example of a dividend stock. A bond payment interest is, let's say for example you have a bond and you give a bond for, let's say, $100, and you have 6% on that 6% on that bond. So for every quarter, or most of the bonds are paid semi-annually, so every 6 months. So you would take that 6% on that $100, which would be $6, and you would divvy it, and you would times it by 6 months. So that'd be $36 that you would get every 6 months. So at the end of the year, you would have $72 extra dollars. So that is just a short introduction to stocks and bonds. If you have any questions, please leave them in the comments below. If you have any criticism or any kind of opinion, leave that below. If you like what you see, hit the like button. If you want to continue to get updates on the videos, make sure you hit the subscribe, and also follow my blog at mybottomdollar.com. The link is in the description below. My name is Kevin Schoon. This is my son Kier, and we're saying bye.
Bye. Okay.